in the last macroeconomics update. I said we would avoid a technical recession. I was wrong. Let's look at why I was wrong and why that means things. Well, they're worse than you're being told. GDP came in at a negative 0.9%. The personal consumption expenditures, aka consumer spending, well, they were up 0.7% in total. That breaks down to a 1.08% reduction in goods spending and a 1.78% increase in services spending. And in the last update, I correctly called this shift from goods into services. However, the spending on services, it wasn't as strong as I was predicting. Part of the reason for that was the fact that inflation continued to be high. And as a result, real wages, which are adjusted for inflation, they continue to be negative. Looking at the latest CPI, or Consumer Price Index, we can see that prices increased 8.5% year over year. And while this is down from the previous reading, it is misleading. If you dive into these numbers, you'll see the food at home price index rose at 13.1%. This is the largest increase since March of 1979. And airline fares were also up 27.7%. The higher cost of food at home, combined with the higher cost of travel, is a major reason that consumers didn't go on summer vacations en masse, and why my services growth call was a bit off. However, that isn't the only reason my GDP call was off. Government spending continued to decline, as it has been over the past few quarters. The spending in Ukraine has also been slower and had a smaller impact on GDP than I expected, which is another reason for this missed call. Note, though, that national defense spending, well, it went positive for the first time in several quarters. And while I nailed the call on the massive decrease in imports, the main reason that the GDP numbers went lower than I expected was the change in private inventories. Our productivity numbers posted the largest drop in history. Productivity, it dropped by 4.6%. The biggest hit to GDP was the drop in private inventories. Businesses are feeling the bullwhip effect, and as a result, have a lot more inventory than expected. They simply didn't see the slowdown in demand for goods coming. And that is why Kathy Woods and others have started to call this an inventory recession. And inventories being high, that might be how this quarter went negative, but that isn't the full story of this recession. At the start of the year, I said we would have a recession in 2022, but I thought it would be later in the year than this. Unfortunately, this means the situation, well, it's deteriorating rapidly and is worse than you're being told by the mainstream media. Let's look at why I think that. The rapid increases in interest rates by the Federal Reserve have started to freeze the housing market. And more hikes are on the way, with quantitative tightening around the corner. And all this is in a continued effort to tame inflation. Since we're in a virtual trade war with China and Russia, our government has almost no options to fix the supply side of this inflation problem. So they have to fix demand. They're going to fix demand by crashing the economy to one degree or another. And we're being told that this isn't a recession because the jobs report looked good. We had more jobs added than expected. But if you dive into the jobs numbers, you can see that the labor force participation rate, it dropped again from 62.2% down to 62.1%, a second straight decline. What does this mean? This means that many of the jobs that were added were part-time jobs and went to people that already had jobs. At the same time, consumer debt continues to increase. So what's really going on here? Well, people are taking on second jobs and running up debt to fight the lowering of their incomes and the standard of living that is being created by this high inflation. Looking forward, workers will not be able to add a third job and will have less income as they have to service the credit card debt in the face of rising interest rates from the Federal Reserve. You know, gas has been a leading indicator of recessions in the past. And yeah, you know, the price of gas, it's dropped by 30% recently, but it's still higher than last year. And demand for gas, it's cratering, which is a huge sign the economy is slowing faster than expected. Let's look at the most recent change in PPI, or the Producer Price Index. we can see a massive drop in producer costs, almost as big as what happened in 2020 due to the shutdowns. And while this might seem like a good sign, like it's good news, because PPI often leads CPI numbers, and you might think that this means that we're going to have lower inflation on the way, well, this drop is way bigger than would indicate a soft landing for the economy. It's definitely something to keep an eye on. Let's end this update with a quick look at the markets. The S&P has picked back up more than half the losses as measured from peak to trough in this cycle. And over the last 50 plus years, this has indicated a confirmed bottom to the markets. Should be good news, right? I don't think that's right this time, though. Conditions have started to deteriorate. We see it in corporate earnings. We see it in the credit market. We're starting to see it in the automobile credit market. Repossessions on subprime auto loans are up 11% since 2020. And the repossession rate for prime auto loans, it's gone from 2% to 4%. It's doubled in that same time frame, meaning that this deterioration is not limited to the lower credit tiers. But if you've watched my other videos, then you know one of my favorite indicators of recession is a particular bond market inversion. That yield curve inversion has predicted every recession over the past 70 years. And that recent inversion, it hasn't stopped. It continues today. So I think we're in a bear market rally, and we'll see more pain in the stock markets later this year. What do you think? Is the S&P bounce right? Have we hit a confirmed bottom? Or is the bond inversion right and we're in for more pain and this is a bear rally? Tell me below what you think will happen next in the economic circus.